Greetings, my name is Ted Hicks. I'm the Chief Investment Officer for Hicks & Associates Wealth Management. Today is Wednesday, July 5th, 2023, and this is going to be our monthly market monologue where I'm going to go into a little bit of depth on the stock market. I'm also going to take a look at a couple of economic indicators that you might find interesting. That said, before we forget, we certainly hope you will hit the subscribe button if you have not already done so. We certainly appreciate that. It does help the channel grow. So before diving into this month's data, I want to first start off by reviewing this chart. This is the S&P 500, and what you can see is that I'm highlighting the fact that this is the month of May. So this is the chart that we looked at the end of May. And what I want to highlight before we dive in is this resistance zone. The market had come down and had finally risen, and we had finally broken through in April, and in May there was a bit of indecision in the market. Is the market going to advance higher, or is it going to squat back down and retest this level? Well, now that the month of June is over, we can see that that decision has been decided, and the stock market, as measured by the S&P 500, had a very positive month of June. In addition, what we talked about at the end of May was the fact that the S&P 500 was positive 0.25%, but approximately 450 out of the 500 stocks in that index were actually negative in the month of May. So yes, the S&P 500 was positive in the month of May, but the average stock was actually negative. Now, if we look at the same data for the month of June, we can see that the index was up about 6.5%, but the average stock in the S&P 500 was actually positive 7.62%. We do see that there's only about 28% of stocks in the index that are beating that index, which is again indicating that the heavyweights, the big boys, if you will, are still doing a lot of the heavy lifting. But now that we're starting to see the average stock is actually outperforming the index, this is actually a very good sign. Switching now to look at the NASDAQ, again, the month of June for the NASDAQ, the tech-heavy index was also a very positive month. And then we'll look at the Russell 3000. Again, this is the month of June, a very positive month for the Russell 3000, where again, we see this resistance level that had built up, and month of May barely peaked through that resistance level, and then June was very decisive in terms of breaking through that level of resistance. Now again, the reason we look at the Russell 3000 is because it is capturing approximately 95% of the United States stock market. The S&P 500 is really only capturing 500 stocks, which is generally the largest stocks in the United States. And then the NASDAQ, while a lot broader in terms of the number of stocks that are in that index, it's very heavy in the tech sector. So the Russell 3000 is doing a little bit better job of looking at the broader U.S. stock market. And so again, we see a very positive month for the Russell 3000. So here we have our seasonality chart. The seasonality chart is showing us the average monthly performance for the S&P 500 since 1950. And the first thing that I want to highlight is that the month of May, June, July, August, and September tend to be very difficult months for the stock market. In the month of June, since that's what we're discussing, the month of June is typically not all that exciting. However, this past June was incredible in terms of the monthly performance. So that's June. Now, July tends to be relatively strong, much stronger than the month of June. However, given how strong this past month was, it will not be that surprising if the broad indices kind of take the month off, given again how strong the month of June was. But again, look at the month of August. It's flat. The average August is flat in terms of performance in the S&P 500. Now again, this is just one sliver of the United States stock market, but this is the most broadly looked at measure for seasonality, is how does the S&P 500 do. Now, that said, let's take a look at the sectors of the S&P 500. Remember, the S&P 500 is 500 stocks, but it's broken down into 11 different sectors. And what's important on this chart is to find technology. it's not at the top. In this case, technology is kind of in the middle of the pack. Had a positive month, positive 4.7, 4.8%, but that actually underperformed the S&P 500. And in particular, I want to highlight the fact that consumer discretionary is taking the top spot in terms of sector performers for the month of June. Now, again, this is good news. When you have one sector, technology in particular, when you have one sector that's performing so well and is consistently the top performer, that is a sign actually of weakness. In order for the stock market to continue to advance, there needs to be a lot of participation in all of the various sectors. I think it was last month in one of the videos I talked about the ice thickening. This is an analogy that I've been using a lot lately. It seems to be making sense with really resonating with clients. And the analogy is ice on a lake. If you see ice on a lake, that does not mean that it is safe to play ice hockey on that lake. If that ice is very, very thin, playing ice hockey would be very, very dangerous. So you have to wait until the ice thickens. And that's really what we saw the first part of the year is, yes, there was ice on the proverbial lake. Yes, the stock market as measured by the S&P, as measured by the NASDAQ, yes, those indices were moving higher, but that ice was super, super thin. And what we're showing you here in this chart, as well as in a couple of upcoming charts, we can really see evidence that that ice has gotten a lot thicker. So it's a lot more safe to get out on that ice and play ice hockey. And again, I'll show you that in just a minute. But this is good news. It is good news that the tech sector did not lead in the month of June. So let's move on to look at some of the broad indices. And again, we see the NASDAQ is definitely taking the cake in terms of year-to-date performers. Next, you see the S&P 500. But what I really want to highlight here, and we'll show this on the next chart, is IWM, which is the Russell 2000, which is small cap or the smaller companies. We've got the all world index, not counting the United States here. This is the New York Composite Index. Here. This is really important for folks to understand. Look at the massive difference between the tech sector, 33% through the month of June, versus the New York Composite Index, only positive 4.7%. Then you've got the Dow Jones, and then we have long-term bonds posting a 1.46% performance for the year, and then aggregate bonds barely positive. It's positive, so that's good news. And I'm not sure we're going to go into too much depth on bonds in this particular video, but at least they are positive 6 months in. But let's zero in and talk specifically about the month of June. Now, again, this is the Russell 2000. What's important, again, on this chart is the fact that NASDAQ, Comp X on this chart, NASDAQ is not taking the top spot. It is the small caps. And again, that's that analogy that the ice is thickening. You have more and more companies, the smaller cap stocks that are starting to perform well. And in the month of June, small cap actually led the way. That is very good news. Here we have what we refer to as participation. This is one of the ways that we are actually measuring the depth of the ice. In the top pane, we have the S&P 500. In this pane in the middle, we have the percent of the S&P 500 that is above the 20-day moving average. And then here we have the percent of the S&P 500 that is actually above their own 50-day moving average, and then again above the 200-day moving average. For those that might be new to the channel or unfamiliar with the terms, the 200-day moving average is really the demarcation line that we would use to determine if a stock or an index is in an uptrend or a downtrend. So we really want to see strong measures here, but we'll get back to that. On the chart, we also have a couple of dates highlighted. I've got February 2nd highlighted right here, and then over here is August 16th. Now, up until recently, February 2nd was this year's high. However, if we zero back into August 16th of 2022, this is when the index, the S&P 500, really kissed this 200-day moving average, and then it got turned lower. So what we want to do is we want to measure how far has the index come since that level, and then what's the percent of what's the participation of the indexes since then? Now, right now, we have approximately 85%. As of the end of June, we have about 85% of the S&P 500 that is above the 20-day moving average. And that is just a little bit lower than where we saw in August of 2022. Now, when we look at the 50-day moving average, we see that right now we have about 77% of the S&P 500 above the 2-month or 50-day moving average. That's well below where we were at back in August of 2022. However, in August 16, 2022, we had about, I think that says 47. It's so close to 50, but look at us now. We are much stronger as measured by an uptrend or a downtrend. So this is actually very good news. So now let's do the same analysis, but this time on the Russell 3000, and this time we'll do it a lot quicker. The lines on the chart are going to measure the same thing. So this green line is measuring back to the August 16th, 2022 high. And what we see is as of the end of the month of June, we are considerably weaker in the Russell 3000. So that is a little bit of a concern. And the percent above the 50-day moving average, August of 2022, we are at 85%. Right now, we're only at 71.5%. But the percent above the 200-day moving average back in August of 2022 is actually 44%. Now we're actually back above the 50% line. We're back about 52% of the Russell 3000, which again captures about 95% of the U.S. stock market. So we would point to this measure here, the percent above the 200-day moving average on the Russell 3000. That is evidence that that ice is getting thicker. Here we have the advanced decline line on the Russell 3000. Again, there's the index itself, and then this is the advanced decline line, this beige line, and you can see that I had a downtrend line measuring going into the month of June. June broke that measure. Now again, the advanced decline line is simply a cumulative total of the number of stocks that are advancing minus the stocks that are declining. So if you have more stocks declining than are advancing, you're going to get a negative slope to the line. If you have more stocks advancing than are declining, you're going to have a positive slope, and that's what we see here. So I have read some research just the last week that shows, that discusses the fact that the advanced decline line does not do a great job of confirming, but it's really a better job of showing a negative divergence. Well, in this case, there isn't a negative divergence. There's actually confirmation. So the recent research being what it is, this is, again, good news. Now we want to look at the percent of the Russell 3000 that are at 12-month, 6-month, and 3-month highs. I won't go into this at great depth. Just know that the trend is improving. So that is good news. A couple more charts, and then we will show you some economic stats. So this is actually the last chart. I take that back. We're going to show you Japan. Japan is at all-time highs, at least going back to like 30 years at least. Japan is in a very strong trend. That is good because I believe Japan is the third largest economy in the world. Now, let's land the plane with a couple of economic charts. I'm going to plan on shooting an economic update video in the next, hopefully the next few days, maybe the next week, and I'll go into a bit more depth on some of the economic data and talk whether or not we see a recession on the horizon. Remember, there's been a loud cry that we're going to see a recession this year. We've been skeptics from the beginning. We remain skeptics, and these next two charts are just a sampling of why we remain skeptical. This is the housing starts. This is again from the Federal Reserve's economic database, FRED. So you can find this yourself if you'd like, and we see that housing starts definitely broke a trend and corrected down. But this most recent update man, that's a massive jump, and I would argue right back up to the up trend line. That is very good news for the economy, because housing starts generally drives other activity as people that are buying houses are then spending money on other things too, like they need a new couch or they need a new vacuum cleaner, et cetera, et cetera. So the fact that we are back to trend is a very good news. The other thing that we see that's very good news from an economic data point is manufacturers' new orders. And again, this recent update ticked higher and created a new high for what is that, many, many years, I would say. So again, manufacturers' new orders is a good sign as well, because that drives a lot of the economy for some of the same reasons. So we'll land the plane here for now. We hope you find these videos helpful. If you haven't already, we do hope you will hit that subscribe button. If you have any questions, whether you're a client or you're not a client, feel free to reach out to us. You can find us at hicks-associates.com. And again, we serve clients out of the Cary and Southern Pines, North Carolina offices, but really we serve clients all over the country in today's digital age. So if there's anything that we can do for you, we would be happy to see if we can't be of assistance. Again, thanks for watching, and we'll talk to you again soon.